All right, I want you to try a little visualization exercise with me.
Okay, I'm with you.
Just imagine for a second, unless you're driving. Please don't do this if you're driving. But imagine it is January 17th, 2026.
Right. 2 years from now.
You wake up, you grab your phone, you check the markets and the news, and for the first time in what feels like, I don't know, a decade,
Yeah.
the world isn't on fire. It's actually, it's booming.
It sounds almost like a fantasy novel, doesn't it? Given where we were in the early 2020s.
It really does. But that is the core premise of the document we are tearing apart today. We've got the 2026 Strategic Investment Report in front of us.
And the shift in sentiment is just jarring. It's optimistic, it's bold. It's basically claiming we've turned a massive corner.
Jarring is the right word. I mean, you have the investment committee from the All In podcast, so we're talking Chamath, Palihapitiya, David Sachs, all of them.
Yep, Caliconis, Friedberg.
Putting their reputations on the line with this thesis. And the headline number they're projecting for U.S. GDP growth. It's huge.
What are they saying?
They are calling for between 4.6% and 6.2%.
Wow. Which is just astronomical. I mean, context is everything here, right? For the better part of the post-2008 era, we were stuck in that secular stagnation mud. We were fighting just to get 2% growth.
And now they're saying 6.
If we hit 6%, that is not a cyclical upswing. That is a structural break. They're literally calling it a new golden age.
Okay, but numbers like that don't just happen. We need to look under the hood. The report points to a convergence of 3 main drivers.
Right. It's a tripod supporting this whole boom. First, you have agentic AI.
We need to be clear what that means.
Exactly. This isn't just ChatGPT writing bad poetry. This is AI entering the labor force to do actual work.
Okay, number 1.
Second, an industrial renaissance, which is being fueled by a specific piece of legislation.
The OBBBA. We'll get to that.
And third, crypto clarity. Finally giving digital assets a real regulated sandbox to play in.
We're going to tear into all 3 of those. But before we get into the weeds, I want to set the strategy for the listener. If the economy is running this hot, how do you invest?
Right. You just throw a dart at the S&P 500 and head to the beach.
Exactly.
The report says absolutely not. They are proposing a barbell strategy, and it's very specific.
A barbell. Okay, what's on the 2 ends?
On one end of the barbell, you have your hypergrowth, deflationary tech. So AI, space, robotics, things that make the cost of doing things go down.
The future stuff.
The future stuff. On the other end, you have hard assets to hedge against inflation. Commodities, real estate, gold.
So you own the future, but you hedge with the physical things that the future relies on.
You've got it. You balance the digital explosion with physical scarcity. You can print code, but you can't print copper.
I like that. Let's start with the physical side then. The Industrial Renaissance. You mentioned the OBBBA.
The One Big Beautiful Bill Act.
Aside from the creative name, what's the actual mechanism here? Why does this one bill matter so much?
It all comes down to one sort of boring-sounding tax provision. The permanent restoration of 100% bonus depreciation.
Bonus depreciation. It sounds like accounting jargon, but my understanding is this is basically a giant coupon for buying expensive stuff.
That is the perfect way to put it. That's the so what. Historically, if a company bought, say, a fleet of trucks or a new robot, they had to deduct that cost over 5 or even 20 years.
A slow trickle.
A very slow trickle. But under the OBBBA, for any assets placed in service after January 19th, 2025, you write off the entire cost immediately in year 1.
So the value of that tax break just skyrockets. If I'm a CFO, I'm looking at this and thinking, I need to upgrade everything right now.
You are. It creates a behavioral shift. It triggers what the report calls a CapEx supercycle. Companies aren't just replacing what's broken. They're proactively upgrading everything to maximize that tax break.
And the report points to a very clear winner from all this spending.
The apex beneficiary, they call it. Caterpillar.
The yellow trucks?
It makes perfect sense, doesn't it? If the U.S. is rebuilding its industrial base, you need earth movers. Caterpillar just dominates the North American market, but there's a second layer to it.
Which is?
Autonomy.
Ah, right, because we still have a labor shortage. It's hard to find people who want to drive a truck in a mine for 12 hours a day.
Precisely. And Caterpillar has been building out these autonomous mining fleets. So for a buyer, it's a double dividend. You get the huge tax write-off from the bill, and you get the productivity boost from a truck that runs 24/7 with no driver.
A convergence of tax policy and robotics. Okay, so Caterpillar is the titan. Are there any other plays maybe further down the food chain?
There are 2 interesting ones. First is Terex Corporation, TEX. They make materials processing machinery and those aerial work platforms.
The cherry pickers and scissor lifts?
Exactly. It's described as a GRAP play growth at a reasonable price. It's cheaper than its peers, but it's essential. You can't build a new factory without aerial lifts.
And the second name?
The Greenbrier companies, GBX. They build rail cars. The logic is just super simple. If you're making more stuff in America, you have to move it.
And it goes on rails.
It goes on rails. More made in America means more freight on the tracks.
It all connects. And for broad exposure, I assume the Industrial Select Sector SPDR Fund XLI is the way to go.
Yeah, XLI gives you the rails, the machinery, the big industrials all in one click. It's the safe way to play that heavy side of the barbell.
Okay, let's slide over to the other end, the tech pivot. We've spent the last couple of years obsessed with generative AI.
We've all played with the chatbots.
Right. But the report says 2026 is the year of agentic AI. How do they define that distinction?
The distinction is autonomy. Generative AI creates content. It writes an email for you. Agentic AI executes tasks. It doesn't just write the email. It sees you're double booked, reschedules the meeting, updates the CRM, and books your flight.
That sounds incredible for productivity, but honestly, it sounds terrifying for software companies that charge per user.
You've just hit on the key risk they identify, the seat count crisis.
The seat count crisis.
It's a massive threat to the traditional SaaS business model. Think about a company like Salesforce or ServiceNow. Their entire model is based on selling seats. You hire 100 sales reps, you buy 100 Salesforce licenses.
But if I have an agentic AI that can do the work of those reps?
Maybe you only need 20 humans to manage the AIs. You buy 20 licenses. The deflationary pressure is real. The report highlights a big bear case for companies like Salesforce, CRM, and ServiceNow, and now W.
So analysts are starting to downgrade them on this thesis.
They are, because the math on per-seat pricing just breaks down in an agentic world. If your revenue is tied to human headcount, and that headcount is about to drop, you have a problem.
So if the per-seat model is dying, who wins? Who's actually powering these agents?
The report calls them the Orchestrators.
Yeah.
And the standout name here is Palantir.
Palantir. I always think of them as the, scary government data company. How does that translate here?
Because in this new world, reliability is everything. You cannot have an AI hallucinate if it's managing a global supply chain or a defense system.
The stakes are too high.
Exactly. Palantir's platform, their AIP, is built on connecting to real-time, ground truth data. They're positioning themselves as the adult in the room for enterprise AI.
So while other models might be creative, Palantir is accurate.
That's the idea. They're the operating system. Then you have Appian, APPN, which is sort of the value play low-code automation with really strict privacy guardrails, and UiPath.
UiPath. They were the robotic process automation guys, right? The screen-scraping bots.
They were, and they are pivoting hard. They are now the bridge. See, most big companies have ancient software from the 90s that doesn't have an API. You can't just plug an AI into it.
Oh, I see.
UiPath's agents can actually interact with those clunky old interfaces. They bridge the gap between shiny new AI and old corporate infrastructure.
That's a crucial niche. Okay, I want to talk about the most speculative part of this whole tech thesis, space.
The SpaceX singularity.
It's a very bold term. The report treats space not as some VC playground, but as critical global infrastructure.
We're seeing that transition happen. And the catalyst for 2026 is the potential liquidity event for SpaceX. It's the elephant in the room. Valuations are floating between $300 and $500 billion.
An IPO would just change the entire market structure.
It would. But the report outlines a rumor that is even wilder.
The reverse merger.
Yes, this is the Chamath theory. The speculation is that Elon Musk might reverse merge SpaceX into Tesla.
Wow. That would fundamentally change what Tesla is.
It stops being a car company entirely.
Yeah.
It re-rates as a hard tech supermajor. You get the autonomy and robotics from Tesla Optimus, FSD, and you combine it with the launch and Starlink revenue from SpaceX, it becomes, well, the most dominant industrial tech company on Earth.
That's fascinating. But let's bring it back to Earth for the average investor. I can't buy SpaceX stock today. The report mentions the Destiny Tech 100 Fund, DXYZ.
It does, but we had to put a giant warning label on that one.
Why is that?
DXYZ holds private unicorns, and SpaceX is its biggest position. But because everyone is so desperate for exposure, the fund trades at a massive premium to its net asset value.
So you're paying, what, $2 to own $1 worth of the actual stock?
Sometimes even more. It's really just a leveraged bet on the Musk economy. If that premium collapses, You lose money even if SpaceX does well. So tread carefully.
So for a saner entry point,
The report suggests Rocket Lab, RKLB.
the Pepsi to SpaceX's Coke.
In a way, they are the clear number two. They have the Electron rocket they're launching consistently, and they have a huge space systems division that builds satellites for other people. It's the public, liquid way to play the theme.
Okay, we've covered the digital boom and the industrial upgrade, but there is a physical constraint that ties all of this together.
Energy.
And the report has this great quote: "There is no AI without electricity, and no electricity without copper."
This is the copper deficit. It is the choke point for the entire 2026 thesis. We are facing a triple threat of demand.
Okay, break that down.
First, AI data centers are absolute power hogs. They need massive amounts of copper for power and cooling. Second, the grid itself is being electrified for EVs. And third, the supply is just inelastic.
Inelastic meaning we can't just dig faster.
It takes 15 years to permit and open a new copper mine. 1.5. So even if the price spikes today, new supply isn't really coming online until the late 2030s.
So, high demand, fixed supply. That's Econ 101. Price goes up.
Which is why copper is a core holding in this barbell strategy. The premier play is Freeport-McMoRan, FCX. They're the big U.S. miner, and they are highly leveraged to the spot price of copper.
And didn't they just resolve some regulatory issues in Indonesia?
They did, which clears up their export path. A big overhang is gone. If you want something more defensive, there's Southern Copper, SCCO, they have the largest reserves, or you can just buy the ETF, GoPX.
But the message is clear. Long copper is a proxy for long AI.
You can't have one without the other.
I love that framing. Okay, let's talk about the financial plumbing. The report calls 2026 the year of crypto clarity.
Finally, the Clarity Act provides the regulatory framework we've all been waiting for. But the prediction here is, well, it's aggressive.
Go on.
The report suggests the U.S. government might actually start accumulating Bitcoin as a strategic reserve asset.
A strategic reserve, like the gold in Fort Knox, but digital.
Exactly. The thesis is that to hedge against the debasement of the dollar and our massive debt load, the U.S. needs a hard asset outside the traditional system.
And if the U.S. government becomes a buyer?
The price targets in the report, $200,000, even $500,000 per coin, start to look plausible.
That is a wild scenario. But beyond just holding coins, the report talks about the financialization of truth. Prediction markets.
This is one of the most interesting emerging sectors. Betting on real-world events. You have Kalshi, which is the regulated institutional side, and then you have Polymarket, which is the crypto-native high-volume side.
And how do we as investors get exposure to that trend?
Well, you can look at Robinhood, 8hood. They're aggressively integrating prediction markets into their app, and of course Coinbase, CoIN, which just benefits massively if that whole regulatory cloud is lifted.
Okay, let's ground this in the last asset class. Real estate. Is the Sunbelt migration still a thing in 2026?
Very much so. People are still moving to Texas, Florida, Tennessee. But there's a new twist in 2026 called the supply cliff.
The supply cliff? What's that?
Well, think back to 2024 and 2025. Interest rates were high. It was expensive to get financing, so developers just start breaking ground on new apartment buildings.
So nothing got built.
Right. And now, in 2026, the economy is booming, people are migrating, and there are no new apartments coming online. Demand is way up, supply is flat, rents are going to spike.
And the top pick to play this?
Mid-America Apartment Communities, MAA, they're the largest landlord in the Sunbelt. They're about to regain massive pricing power.
There was one more real estate nugget in there I thought was brilliant. It was about Prologis, the warehouse giant.
Oh, this is the hidden gem of the report. So, Prologis, PLD, owns these massive industrial parks. But it turns out many of their land banks are located right next to major power substations.
Which brings us right back to the energy bottleneck.
Exactly. They aren't just storing Amazon boxes anymore. They're in a prime position to convert those warehouses into data centers because they have the one thing no one else can get: grid access.
It's a real estate play that's secretly an AI infrastructure play.
You got it.
Incredible. Okay, we have covered a massive amount of ground here. Robots, rockets, copper, digital gold. Can you synthesize the final recommended allocation?
Sure. It's a 40-30-30 split. 40% is your core growth.
Right.
That's agentic AI like Palantir, space proxies, and fintech like Robinhood.
The boom stuff.
For your exposure to the boom. And 30% is industrial and real assets, the heavy side of the barbell. So Caterpillar, Freeport for copper, and real estate like MA.
And the final 30%?
That's your macro hedge. Bitcoin, gold, and cash. That's your insurance policy.
Before we close, there was one final contrarian hedge mentioned, specifically about China.
The bifurcated tech stack. The idea is that despite all the U.S. sanctions, China must develop its own semiconductor capabilities. It's an existential necessity for them.
So they will spend whatever it takes.
Infinite capital. The play here is SMEC Semiconductor Manufacturing International Corp. The thesis isn't that they're better than NVIDIA. It's that they are a sovereign necessity. The Chinese state will not let them fail.
A risky but maybe uncorrelated bet?
Exactly.
So bringing it all home, the world in 2026 is booming, but it's different. You have deflation in labor, those saw seats, but inflation in physical things like copper and energy.
That is the key takeaway. The old playbook of just buying software and ignoring the physical world is dead. You need to own the scarce resources, and you need to own the autonomous systems that are replacing labor.
And keep an eye on that SpaceX ticker, or maybe the Tesla ticker, because if that merger happens, it changes everything.
The rocket is leaving the pad. You just have to decide if you're on board.
A compelling roadmap for the years ahead. Thanks for guiding us through the report.
Always a pleasure. And to you, the listener, thanks for taking this deep dive with us. We'll see you next time.